Market capitalization of SMEs is surging to almost $2 trillion. In fact, and hence, regulators are sounding more warning bells around some of these SME IPOs and, of course, the frenzy that follows them. So let's understand how SME IPOs have been shaping up and why are they caught in the limelight right now and why are these warning signals being sounded. Of course, we do understand that there is that factor of these being unsafe due to the kind of claims that have been made by promoters of some of these IPOs. But let's understand the larger story and go across to my colleague Sharad. Sharad.
Well, the SME IPO space has been bringing a lot of issues over the last 2 or 3 weeks, and a lot of stakeholders from different segments have been vocal about it. First one being, of course, SEBI's whole-time director Ashwani Bhatia has also stated that eco players such as investment bankers and chartered accountants should also give right advice to the startups or the companies which are coming in for the IPO. And they've also stated that instead of going straight to an IPO, a better route might be an angel fund or venture fund. Even Ashish Kumar Chauhan, MD and CEO of NSE, had stated that the maintaining of balance and strict guidelines should be there when it comes to the SME IPO. And there's a perception that still there is currently the markets are doing very well and many of the fly-by operators also might be there. Also, there is a support coming in from NSE when it comes to SEBI's push for tougher regulations on SME IPO as well. There are key cases also which I'd like to point out. First one being a delay of IPO of Archit Newwood. Of course, queries have been raised by exchanges, especially on the margin front as we compare it to their peers. And also this IPO has been managed by Share India. The grey market price has actually crashed from 100% to almost coming in the discount levels. Even Share India's issues, if you look at it, there are certain bigger names such as VVIP, Infratech, and even Pune East stock making it to the list. Now, Resource Automobile, recently listed company, and of course the price is flat at its IPO price. Now, this was just a 12 crore IPO, but the subscription numbers was humongous, 400 times subscription, 2,700 crore worth of subscription bids come in. But yes, the grey market premium evaporated on the day of listing as well. Also, there are certain top SME IPOs this year itself where the subscription numbers have been very huge. HOAC Foods, KC Engineering, Medicam and Organics, these are to name the few stocks where the subscription levels have hit more than 800 odd times. A word of caution, of course, coming in from stalwarts in the industry as well. But if you look at the BSE SME IPO index, the story is something else. 1 year itself, it has risen 184%, while from the recent tops, you say a week or 10 days, it's down by almost 3%. So overall, a lot of chatter coming in the SME IPO space, and also importantly, you should be caution going ahead.
In fact, staying with that story, SEBI's findings have revealed that more than half of the IPO shares allotted to investors were sold within a week as far as some of these SME IPOs are concerned. The study also finds that more and more investors are now offloading, IPO shares to clock in those listing gains, alluding perhaps to a flippant behavior of investors. And we caught up hence with market veterans, the likes of Mahesh Nandurkar and Sunil Subramaniam, to understand what they make of this and how should one move ahead given the regulatory concerns. Let's listen into what they had to say.
We looked at some of the recent news flow in terms of a small IPO, kind of trying to raise about 11, 12 crore, getting subscription worth about 5,000 crore. So clearly, these are all signs where we are seeing, excessive exuberance in certain pockets, of the market. As you rightly mentioned, SME probably looks like one. But I think that could be applicable for some of the small cap, mid cap names in the main market, as well. So yeah, I think the regulators are warning the individual investors, around this. But I guess at this point in time, what is really working is, things are looking good. People are making money, and that's why one is leading to the other.
Post-COVID, we have had these youth who have come with a lot of time on their hands, with internet and technology at their hands, who are treating the stock market like a gambling den. I think this is all part of a healthy capital market. It's only when you have these speculative entities like these people come in that there is liquidity in the market. But if you regulate them and take them out, overall as a market, the liquidity is going to shrink. Putting any regulations, right, which gives the signal that SEBI says this is, irrational exuberance, is that those kind of words could trigger a collapse. So I think we need a regulated move from this chaos and it's not easy. I would suggest we start by first talking, advising, guiding before we introduce any harsh actions which could give a wrong signal to the market and lead to a domino effect.
If you like this video, then like, share and subscribe to ET Now.